Ever wondered if you could make a big play on the stock market without putting up a ton of cash? Well, that's exactly what we're digging into. We're talking about a financial tool called a call option. Let's break down how this whole thing works.
I mean, controlling 10 grand worth of stock for just 300 bucks? It sounds a little crazy, doesn't it? But believe it or not, it's totally possible. And it all comes down to this powerful idea called leverage. Stick with me, and by the end of this, you'll see exactly how it's done.
All right, let's set the scene. Put yourself in this mindset. You've done your homework, you've been watching a certain stock like a hawk, and you've got this gut feeling, this conviction that it is about to take off. So let's use a made-up company. We'll call it XYZ stock. Right now, it's trading at a nice even $100 a share. And you're feeling super optimistic about it. You think it's undervalued and it's just coiled up, ready to spring. So the big question is, what's your move? Okay, so you've basically got two choices on the table. Path number one, you could buy 100 shares the old-fashioned way, but that's going to tie up a hefty $10,000 of your money. Or there's path number two. For just 300 bucks, you could buy a single call option contract, which, get this, also lets you control 100 shares. That huge difference in the upfront cost, that's your first big clue about the power we're talking about here. So you decide to go with the option. It's a smaller, more surgical bet, right? But what are you actually getting for that $300? Let's peel back the layers and see what you're buying. First thing you need to know about is the strike price. In our little story here, let's say it's $105. The best way to think about this is like you're locking in a special price just for you. No matter how high that stock might shoot up, this contract gives you the right, and notice I said right, not requirement, to buy 100 shares at exactly $105. Now, a right like that isn't going to be free, right? The cost for that right is called the premium. In this case, it's $3 per share. I love this analogy. Think of it like a non-refundable ticket to a concert. You're paying for the chance to see an amazing show, but hey, there's no guarantee the band is going to be any good. You're buying the opportunity. Okay, so let's do the simple math. The premium is $3 a share, and one options contract always controls 100 shares. So 3 times 100, yep, that's $300. That's your total cost for this bet. That's your price of admission, the whole shebang. And this right here, this is one of the biggest reasons people get interested in buying calls. That $300 you just paid, that is the absolute most money you can possibly lose. That's it. Your risk is totally defined right from the get-go. Your downside is capped. All right, so you've made your move. Your $300 is on the table. Now, we hit the fast forward button. See, your option contract isn't good forever. It has an expiration date, maybe 1 month from now. And that means the clock is officially ticking. So this is basically the life of our trade. You place the bet, a month goes by, the market does its thing, up, down, all around, and now here we are, expiration day, the moment of truth. Time to find out if your hunch was right. So on this final day, the path splits. Two possible futures lie ahead. In one, you absolutely nailed it. The stock skyrockets to $110 a share. You, my friend, are what they call in the money. But in that other future, the stock just kind of fizzled out. It didn't make the big move you were hoping for, and it's trading below your $105 strike price. In that case, your option, that concert ticket, well, it expires worthless. Okay, let's forget that sad timeline and focus on the winning one. The stock is at $110. You were right, but what does that actually mean for your bank account? Let's crunch the numbers. Okay, check this out. The stock is selling on the open market for $110 a share, but your contract lets you buy it for your locked-in strike price of just $105. That difference immediately creates a $500 gain on paper. Now you just have to subtract the $300 entry ticket you paid for the option in the first place, and what are you left with? A nice, clean $200 net profit. Now, listen, a $200 profit on a $300 bet? That's a heck of a return. But this brings up a really, really important question. The stock clearly went past your 105 strike price, but at what exact point did you actually start making money? When did you cross over from the red into the black? This magic number is called your break-even point, and thankfully, the math is super simple. All you do is take your strike price, the 105, and add the premium you paid per share, which was $3. That gives you 108. So the stock had to climb all the way past $108 just for you to get your initial investment back. Every single cent above that was pure profit. This chart really paints the perfect picture of our trade, doesn't it? On one side, you have your maximum possible loss, which we knew from the very beginning was locked in at $300. And on the other side, in our winning scenario with the stock at $110, you've got your $200 profit. It's a perfect little snapshot of the risk you took versus the reward you got. Okay, so we've walked through a whole trade from start to finish. Now let's zoom out a bit and make sure we lock in the big picture lessons here. What are the key takeaways?
This quote from the source material really nails it. It says, call options let you control 100 shares with less capital. And that's that whole idea of leverage we talked about at the beginning. It's what makes options so appealing for making a big bet, but it's also a double-edged sword. That same leverage is what makes them risky.
So, if you're going to remember anything from this, remember these 4 things. 1, limited risk. The most you can lose is what you paid upfront. 2, leverage. You get to control a big stock position for a small amount of cash. 3, break even is everything. Your profit doesn't even start until you've covered both the strike price and your premium. And finally, number 4, a very real risk of 100% loss. If that stock doesn't move enough or moves the wrong way, that entire premium you paid can just vanish.
So there you have it. We've gone through the mechanics, the what, the how. We've seen the potential for profit and the very clear defined risk. So the last question, well, it's not for me to answer. It's really for you. Now that you've seen how this tool works, the big question is, how could something like this fit into your own strategy and your own comfort level with risk?